Welcome, Making Money. This is Matt McCall. Thanks for joining me. It's the 26th of September, 2023. It's a Tuesday, back in the home base Baltimore office, as you can see. We got a big show coming up for you. We're going to take a look at Q3, what were moving markets, what were the big themes, but more importantly, what does it look like for the fourth quarter? We have a lot going on. We have the Fed, we have inflation, we have housing, we have artificial intelligence, all that and more, all the big topics you need to know heading into the last 3 months of the year. All coming up right now on Making Money. Nvidia may be America's top performing stock after more than doubling this year alone. But if you're holding Nvidia or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular in many news outlets from Fox Business to CNBC and built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found Nvidia at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from Nvidia. My system has indicated that Nvidia is no longer the best stock to buy to profit from AI, is what Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzy23.com. Again, that's aifrenzy23.com for a free copy of his new report. Again, this is Matt McCall. Thanks for joining me. It's the 26th of September, 2023. And as I mentioned, it is a nice Tuesday here in Baltimore. So I want to talk about the third quarter, and more importantly, I want to jump into what's going on in the next 3 months and the areas that you need to keep an eye on. You know, the big theme really the last 3 months has been kind of this push and pull between the bulls and the bears. The bulls, which is my camp right now, and a lot of times it is as a long-term investor. In the bullish camp, you know, to me, the long-term uptrend, which began October of last year, so about 1 year ago, is still intact. I believe valuations, which we'll talk about a little bit later in the show, not only here for the U.S., but some foreign markets that are very interesting. The valuations are not near bubble levels, regardless of what they may say in the mainstream media. And really, the trend and momentum is still at the backs of the bulls. The bears have been running with the same argument for a while now. The Fed, obviously, raising interest rates dramatically over the last 2 years. Inflation going up through the roof over the last 2 years. But both of those outside catalysts have turned in the other direction, especially here in the third quarter. And going forward, we have now the second pause in the Fed last week. So they're pausing once again. And we'll talk about, again, my outlook for the Fed in the next two meetings in 2023 and then the first couple of meetings in 2024. Inflation has been coming down dramatically since peaking earlier this year. And I don't see that trend really ending. It's not going to come straight down to that 2% goal the Fed has. I don't think that's attainable anytime in the near future. All that being said, inflation is coming down to levels that are much more digestible for investors. And I believe, again, that that's a story that will go by the wayside as quickly as it came. It will be that quick to move to the side. The Fed will always hang around because they're always going to be in the news. But I think inflation could definitely move to the other side. So let me show you a chart here. This is a chart of quarter to date, going through the third quarter. And as you can see, I put some major indices on there. And leading the way was the QQQs, which is a NASDAQ 100, which is the 100 largest stocks in the NASDAQ composite, ex financials. So slight gain. Really right there with it is the SPY, the S&P 500, both about 0.25% gain. Down a little bit more, we have the Russell 2000, the IWM, which is small mid-cap index, down about 3%, so lagging. And we'll talk about small mid-caps in a moment. They've been lagging for a while. And also threw in there the microcap ETF, IWC. That's down about 6%. Also down about 6%, I threw in the ARK Innovation ETF, ARKK. So as you can see, some of the bigger names, the S&P 500, the Nasdaq 100, 100 large companies, have been leading the way. Now, if I look at the year to date, things do change quite a bit. We see here now leading the way is the QQQ still, which is, again, the big names: Apple, Microsoft, Google, Amazon, etc. But hanging right there with them, even though they were underperforming the last 3 months, is the ARK Innovation Fund, of about 33% year to date. 17% the S&P 500 hasn't really done much the last few months, as we just talked about. Then we have the Russell 2000. Again, small mid caps have been lagging really all year. They're outperformed a little bit in February, but outside of that, they've underperformed, only up about 5% year to date, and then lagging dramatically, well below the QQQs, is the microcap index, IWC, down about 4%. So I got to tell you, folks, one theme I see going forward here, we're talking about a lot of themes. And again, as a long-term investor, I talk about this theme going into the fourth quarter, but obviously it's going to be much longer than that. Is a small mid caps. I believe there's a lot of great opportunity in small mid cap companies right now. One major reason they have been lagging is typically during times when interest rates are rising, small mid cap stocks will underperform. The reason for that is a lot of the small cap stocks are not yet profitable, and a lot of them need to bring on additional capital, additional money for their growth and expand. And when interest rates go up as quickly as they did, that means the cost of borrowing that money, which is based off the Fed funds rate, what the cost of borrowing that money becomes much more expensive. So obviously the bottom line gets hurt. So that's why you see small mid caps. That's just generalizations, other reasons, but that's a generalization as to why. But again, with inflation coming down, with interest rates, Fed likely paused. We'll dive into the Fed in a minute, but the Fed likely paused, and next move could be next year a rate cut. I think they've peaked out the interest rates where that's only going to help the small and mid cap stocks. And at this point, they're so beaten down to such great valuations. I think you want to really turn your attention to some of these small mid cap stocks at this point. To give a little more evidence of just how strong the large companies have been, Ned Davis Research, which has been around a while, they looked into the ACWI, which is the All Country World Index, so not just U.S. stocks. And they realized now that nearly one-fifth of that entire market cap of that large index is now made up of just 10 names, all U.S. names. And obviously, a lot of them are the Mag 7 plus a couple others. And according to their research, it's a record for the most concentration for the top 10 stocks ever. And as I just said, all U.S. stocks. So we're going to talk about valuation of big tech stocks in a moment. But I got to tell you, folks, this tells you something. And I'm not saying this trend is over. I'm not saying you go out and sell all your large cap stocks. I'm not saying the Nasdaq 100 is going to start moving down. But at some point, there's a reversion to the mean. And what that means is when you have the large caps up here and the small caps down here, they revert to the mean. And that could be either the large caps getting crushed and small caps go sideways, or the small caps outperform on the upside. And I think that's where we're going to see it. I think we're going to see great outperformance in the next, I hate to say 3 months, but going forward over the next few years, I think the small mid caps in general will outperform. I think there's a lot of great opportunities, especially for stock pickers out there, like what we do here at the McCall Report. So again, the big guys have been leading, and I think it's time for the smalls to come back. Let's talk about the Fed. Just paused last week, as I mentioned. No surprise there. Going into last Wednesday meeting, it was a 99% chance they're going to pause. So the market at that price stand. So no big surprise there. But if you take a look at the CME, they put out their projections, market projections of what the Fed's going to do in the next couple of meetings. There's a meeting in November. There's also a meeting in December. It's now below 50% chance that they raise at either meeting. If we keep going forward, it's below 50% chance all the way out until June. June is the first time that the majority is not just leaning to where we are right now, as far as the Fed funds rate. So basically, they're saying Fed's going to pause until June. Again, this could change dramatically, but they're saying they'll pause until June. However, at the June meeting, they're not saying a rate hike. They're saying a 25 basis point, 0.25% rate cut. And that was actually much earlier in the year. They've pushed it back. For me, it's too far out to really try and guess that. I hope that the Fed is done raising rates at this point. I don't think another 25 basis points or 50 basis points is going to do a lick of difference for what they're trying to achieve. I don't think 25 basis points is going to knock down the price of oil, which is near 1 year high. Gas prices continue to go up. I don't think it affects it. So at this point, the Fed has done what they've done, and we have to let it play out. And again, I'm not a huge fan of the Fed, but I'm not going to sit here and bash them either. I think they could have actually probably stopped a little bit sooner and just went really, really fast and pulled the Band-Aid off. But the thing is, we are at where we're at now when it comes to the Fed funds rate. We've gone up dramatically, and I think we have to let that play out. Let that roll over into the economy. You don't just raise rates and suddenly slow down the economy and make inflation come down. It just doesn't happen that quickly. It takes time to roll through. And it is starting to roll through. You're starting to see it. Some home prices coming down. We're seeing inflation come down. We're seeing the jobs market not as rosy as it was. Still strong, in my opinion, but not as strong as it was. So, again, folks, give it time. But to me, the Fed is done. And for the next 3 months, I don't think we're going to have to worry about the Fed raising interest rates, which, again, should be good for equities in general and more specifically small mid-cap stocks. Obviously, we're talking Fed, we've talked inflation. Um, Inflation, to me, will continue to come down and maybe a point where it kind of goes sideways, but we've come well off the highs. The big thing that I've been talking about for a long time now, and this is the shelter, the housing market. Shelter makes up about a third of the CPI, the Consumer Price Index, which the government puts out. And even though rents have come down, shelter, as measured by independent sources, has come down dramatically. It's lagging for the CPI, and this is just known. It's a known anomaly when it comes to that government statistic. It's just what it is. And you're starting to see it really start to roll over a little bit, but there's a ways to go. And as that comes down, being a third of the entire calculation of the headline number, I mean, CPI is going to come down quite a bit. So I think that's something that we can't ignore, the fact that the shelter prices still are elevating the headline number, and those will come down. Gas prices, they remain elevated, though. Not much I could say about that. We have oil prices rallying to very close to a 1 year high recently. And normally when it comes to gas prices, there's an old saying out there that says, falling leaves, during autumn, fall months lead to falling gas prices. It's not what's going on this year. It's closing in on a 1 year high for gas at a time where typically you see the gas prices nationally falling. It's actually been increasing. Obviously, this has to do with rising oil and an economy that's still pretty damn strong, to be honest with you. And this one thing, to me, I've done these studies over years when gas has gone up and spiked, several times over the last 15 years. I've always done a study of how many miles somebody actually drives, the average person, their average family. If gas goes up an extra 50 cents a gallon, what it truly means to the bottom line of your wallet and your income, your disposable income you have left over. I got to tell you, folks, it's really not much. I know it seems like it to a lot of people, and I'm not saying some of you drive much more than others, so it will affect everybody differently. But in general, it's not typically that big of a change. Food prices, housing prices will have a much bigger effect on you than gas prices will. However, whether the numbers you agree with or not, it affects you mentally. And the consumer being still 2/3 or so of this economy, if it affects somebody thinking, well, if I'm paying an extra buck at the gas station to fill up my tank, that means I'm not going to dinner this week. Normally I go 2 times, I want to go 1. I'm not going to buy an extra pair of shoes, or whatever it might be. So it could affect the consumer, which then would affect the economy. So this is something I'm keeping a close eye on. We have to keep an eye on gas prices, because if they don't start coming down, it could truly affect this economy. And talk about oil prices in a second, but I was Googling oil prices just to get some insight into it today. And what spiked up was the fact that olive oil prices are spiking. You thought it was bad for oil. You thought it was bad for food. Olive oil prices are up 130% over last year. Olive oil. I guess there's some extremely dry weather in the Mediterranean, especially Spain, which has led to less crops of obviously olives, which means to less supply of olive oil. To the point, there's been several major thefts at olive oil factories and plants where people are coming in stealing truckloads of olive oil. It's amazing. I mean, the stuff that you hear sometimes when you get on the internet, and I verified this through several sources, it is true. This isn't something that's out there, but it's amazing. So olive oil prices, you're not alone, folks. And for me, who I love olive oil, I think it's a very healthy oil for you. I didn't realize it was this much more because I usually buy it in such big things. I haven't bought it in a while, but now I know going forward, maybe it's time to stock up on olive oil. So as I mentioned, oil prices, we'll talk about commodities here for a minute. Oil prices near 1-year high. And, we're near $90 a barrel here, the WTI, which is West Texas Intermediate, which is a U.S. Oil. There's also Brent, which is measured overseas in Europe. But we always talk about WTI here in the show normally. It's around $90 a barrel. But if you go back to when it peaked in 2008, and you adjust it for inflation, uh, that price back then would be about $184 a barrel. So we're still quite, I mean, half where we were. Nobody's going to hear that and think that that's good or anything, but I'm just telling you, put in perspective that actually 15 years ago, if it was adjusted for inflation at that time, it'd be trading about 183. We're down to 90 now. So, but again, it still hurts the same when it makes oil prices go up. When oil prices go up, makes gas prices go up. We feel it to heat our home, etc., cool down our home. So I know it is real. The one problem I have with what the government's done over the last year or two is we did have oil pullback. We also had oil during the pandemic at basically zero. And unfortunately, they were not being aggressive in adding to strategic petroleum reserve. And we know the Biden administration a year or so ago came out and said, we're going to release some millions of barrels of the SPR, as it's called, to help fight gas prices. It didn't do crap. We all know that. And it just took down the supplies we have. So let me show you. This is the Strategic Petroleum Reserve. This is the stocks we have, about 351 million barrels of oil right now. You can see we are much higher. We were above 700 back in early 2010s. And again, we got a little bit in 2020, but we should have been well above that, getting at basically zero. We're now down near levels we have not seen since the mid 80s, folks. And this is sad because what's going to happen is if we have to add to this, or if there's some type of oil shock or something happens overseas, you never know. We could be screwed. We could truly be screwed. This is a concern. But this goes back to government being involved in this type of business and not knowing what the hell they're doing. Whoever runs this is doing a horrific job. And I remember asked former governor of Texas and former presidential candidate, former director of energy, Rick Perry.
Well, who makes a decision? Would that have been you, the president? Who makes the decision to say we're buying oil?
Basically, it gets to the president.
Okay.
I mean, obviously, there's some other people involved and what have you. Yeah. He listens to the Secretary of Energy, the bright men and women that are over there. But at the end of the day, it's Congress and the president that makes that decision.
Yeah, he didn't really give me an answer to it. I want a direct answer. What person is responsible for this? And if it's the president, then he's failing. I don't know who it is. I don't care if they're left, right, center. Whoever's in charge of this SPR, folks, is failing, or I should say has failed, and continues to fail. So we need to figure this out. When it comes to investing opportunities, I think there's still that whole barbell approach. I think it's one of the great investment opportunities of the next 10 years. When I do my investments, I have different portfolios, whether it be the future of transportation, which could have EVs in there, could have battery companies. It could have software companies for EVs, for autonomous vehicles. It could be auto parts makers that make parts for electric vehicles and autonomous vehicles. It could be a lot of different things. And one of the baskets I really like is what I call the energy barbell. One side you have this fossil fuel, the traditional energy, which is oil and gas, etc. On the other side, you have the renewable clean energy, solar, wind for the most part. Nuclear fits in there. I'll talk about that in a second. But I still think it's the best way to go. And I'm going to show you a chart here, though, of why you really need to have both sides of this barbell. This is the third quarter of that barbell, if you will. You can see, again, in the middle, there's the S&P up marginally. Then above that, you have the XLE, which is the large cap energy stocks, up about 13 and a quarter. And then on the downside, I just put in TAN, which is the solar ETF, down 23.5%. I mean, solar was pretty specific that I did there. I mean, there's other clean energy indices I could have used, but that's just kind of a one way look, because a lot of it's going to have exposure to solar. I mean, there's wind out there as well, but for the most part, it's going to be solar. If I looked at the clean energy ETF, still down about 17%. So you get the point. So again, let's just go back to this chart here really quick. If you split the difference and say it's 17, so you're down 4%. Split that by 2, you're down about 2% on average versus if you just had, let's say, clean energy down 17%. So it really mitigates your risk by having both sides. And there will be a time over long term where they both do well. So I think you can't give up. You can't give up traditional, because I've talked about this so many times on this show that we can't get anywhere near the goals of renewable energy without fossil fuels for at least 20, 25 more years minimum. So there's going to be demand. And unfortunately, there's not a lot of supply coming online because a lot of that money's been taken away. So there's not supply. You need a renewable energy because that continues to grow. The numbers are there. The facts are there. We need both. So don't give that up. But again, that is one of my favorite long-term investment baskets, if you will, portfolios, if you will. Another area which I'm actually doing a write-up on right now, and for our McCall Report subscribers, we're launching a entire basket, as I just talked about these baskets, on nuclear energy. It's going to include some uranium stocks, some nuclear energy plays, some infrastructure plays. I've been high on uranium for a while. Last year, just last week, we hit a 12-year high in the price of uranium. Most people don't know that. 12-year high, above $65 a pound now. It is going through the roof, and some of these nuclear stocks are really breaking out. If we take a look at some of the nuclear ETFs, which this doesn't invest in uranium, but in stocks related to it. I mean, look at this, folks. This is the VanEck Nuclear Energy ETF, symbol NLR. I mean, what a performer. I mean, this is breaking out to a year high. And if I zoom out on this chart, you can see going all the way back. I mean, this is a major breakout. It's the best level we've seen since 2011. We're looking at a 12-year high, folks, for the nuclear energy ETF. This is in the light of people being concerned and nervous about everything. There is a renaissance going on right now. I tell a story in the upcoming issue about a guy by the name of Charlie Steen. Amazing. He's basically the godfather of uranium mining in the United States. And he packed up his family of 4, put them in a car, drove out west from Texas. He was a geologist in oil and gas, took his Geiger counter and started walking around Utah for 3 years. Finally hit, boom. It led to the big uranium boom we had in the 50s into the 60s. And I think we're about to have another one. I really do. And the people out there that think nuclear energy is dirty and dangerous, please do your homework, because there's not one thing that's further from the truth. It is not just not true. It's fact checked, not true. So uranium, I have a bunch of ideas coming out. I obviously don't want to share those here because I have those coming out for our subscribers. But I do see some great opportunity there. The last one I touched on is gold. Gold during the quarter down slightly, really hasn't done much for the most part. It's basically flat to down a little. I show you a chart here of GLD that tracks the gold price, though. It's in a downtrend since topping out in May, lower highs, lower lows, and it's at a point now where it might break out this downtrend. It might run higher. Who knows? But right now, again, it's just been dead money, and I don't see any reason to jump into it. It doesn't fit into any of my investment themes at this point. I know people who love gold hate me anyway, so it doesn't matter. But I'm not saying you should never own gold. I just don't think right now there's a case for it. If you're getting 5% or so in a money market, I'd rather own that than gold as my safety, 100%. Okay, and some other themes I want to look at, and one that we cannot overlook, and I've talked about a lot, so I'm not going to go into it too deep, is artificial intelligence. AI has truly been kind of the theme of the majority of this year. And I don't see that ending anytime soon. A lot of stocks have pulled back. The big leader of that, Nvidia, it's pulled back from $500 a share down about $430. So it's pulled back over 10%. We could take a look at, Apple's not really an AI play, but they put it in there. That's fallen from about $200 a share to 177. So that's fallen as well. Microsoft, I guess, is by proxy an AI play. It's fallen from about 365 down to 325. So a lot of these big names that were AI related, the Mag 7, have pulled back. So we have seen a bit of a pullback in that. Goldman Sachs did some really good work here as of late. I'll show you a couple of charts I took from them. First one I show you here, this is they made these indices, and they took what they called near-term AI beneficiaries, the NVIDIAs, Microsofts, all the big names. And then he looked at long-term AI beneficiaries. And I got some of the stocks that are in there, but I'm not able to find the true component makeup of it. But it could be anywhere from software stocks that will take over, that it will help, AI will help productivity, to even some energy stocks where AI is going to help predict productivity. They looked at companies where AI is going to truly increase their productivity, which will increase earnings over the next few years. So let me show you this chart, folks. This is year to date. The dark blue line there that's the near term beneficiaries. That's the big names I just talked about. I mean, you look, this started at a basis of 100. It's up around 160, so about 60%. And then the light blue line, the long term AI beneficiaries, up less than 10%. And I'm showing this because I believe that there's an opportunity in the long term for artificial intelligence. I've said this before. When a new megatrend, not a fad, but a long-term megatrend comes along, the market tends to overestimate it in the near term and have these huge run-ups, but greatly underestimate what it does in the long term. And you see this you go back 120 years. Any major breakthroughs and trends that we've had, if we have stocks, publicly traded stocks that we can correlate to them, you'll see this trend, folks. It is exactly what happens. And you know why? Because investing goes back down to several simple things. One is human emotion. We get wrapped up in emotion. FOMO's only been around for 10 years, that whole term, fear of missing out. But people have been FOMOing for hundreds of years, if not thousands of years. You think the first guy who was able to light some fire in his cave, the other guy wasn't pissed off and wanted to get fire in his cave? Fear of missing out. We all wanted it. We all wanted fire back then. The same thing, the first person who had heat. I mean, you ever see there's a commercial out there, or it's not a commercial, I think it's a Family Guy episode. And it has Thomas Edison lighting up something. It's somebody in their house doing it, and a guy across the street yelling because his house was all lit up playing rock music. And the other guy had, burning wood. But the point is fear of missing out. That FOMO is what leads to these large short-term gains. But again, we underestimate the long term. So that chart I just showed you, it gives you a good idea of how, it's going to take time for these secondary beneficiaries to play out, for the AI to increase their productivity, which increases earnings. When we increase earnings, folks, stock prices go up. It's very simple. They also put in here, which I think this is really neat. This is a chart looking back at 2 times that were bubbles. And when a large portion of the indices were made up of some big companies. Tech bubble, you can see here, and then you take a look down at the Nifty 50 bubble here. And the top one is where we are today. They call it just big tech. And again, I don't think this is a bubble, but it looks at the valuation, the 24-month forward PE ratio. For where we are right now with the big 7, it's about 24.9, call it 25. At the tech bubble, at the height there, was 52. So more than double. You look at 24-month forward EV to sales, enterprise value to sales, 4.4 where we are now for the big guys, 8.2 during the tech bubble of 99, 2000. So nowhere near that. So when people start saying that, we have to get off that. And then you look down even to the Nifty 50. I mean, look at these big names. IBM, still around, obviously, working on quantum computing. Eastman Kodak, done. Sears Roebuck, done. GE, lagging. Xerox, done. 3M, Procter & Gamble, But their forward valuation there, 34.3. Again, still well above where we are today, folks. So it's a great way to look at past bubbles and try to equate to what we are in a bubble here. The only thing I could see us getting into is if we continue to move forward and these big 7, they double again in the next 24 months, then we're probably in a bubble. Those valuations are probably near bubble valuation. But those are only the big guys. It doesn't mean the entire market's in a bubble. And the last chart I'm going to show you here with some other outside opportunities of the U.S. shows you this. It's going to show you the valuations outside of everything else. So let me show you this. This is, again, a great chart. This looks at 12-month forward PE multiples. And all the way to the left here is U.S. tech. And that range, the blue range you see there, that's interquartile range. The little dot in the middle, that's the median. Current is going to be the diamond there. And then the 10th and 90th percentiles, that's the whole thing. So we're above the 90 percentile for U.S. tech, well above where it normally is at 27.5. Normally it's at 18, the median. So well above. We just look at U.S. in general. Again, higher end of that 90th percentile, well above average, but nowhere extended like the U.S. tech. Then we look at U.S. ex big tech. Take away those big 7, folks. we're not far outside of our normal interquartile range, well below the 90 percentile. So we're not that far. The median's around 15 and change. We're at 16.8. Look at AC World. Again, not too far outside our interquartile range. So those four right there give us a big indication that if there's a bubble anywhere, it's in the big 7, the big 10, whatever you want to call them, the big names. Outside of that, we're nowhere near a bubble. So get that bubble term out of your mouth when you're telling friends and talking about the market. You could talk about big tech. I don't think we're there yet, but we could get there, but we're not there yet. Now about other outside ideas. Japan, let's look at Japan here, trading right at its median. Asia Pacific ex-Japan, right at its median. Developed Europe, below it. Developed Europe's been getting crushed ever since really the Ukraine war. Emerging markets, right around its median. Europe ex-granolas. I got to tell you, I don't even know what the heck that even means, but it's well below. I'm going to have to look into that. United Kingdom, way down by the 10th percentile. So there is great opportunity overseas. I had Brendan Ahern on last week, CIO over at Crane Shares, and they do a lot of emerging markets, especially over in Asia. And we were talking off air before we did the podcast out at the Future Proof in Huntington Beach a week and a half ago. Who's going to be the first person who steps in? And I'm talking big money, not talking about you and I as individual investors, but people who run huge endowments and run big hedge funds and large mutual funds. Who's going to be the first one that says, you know what, let's add some more exposure to Asia Pacific. Let's add some more exposure to emerging markets. What about developed Europe? Because you don't lose your job as long as you do as bad as everybody else is doing bad. When you start kind of going out on a limb and you struggle, you're done. You go on a limb and you do well, you're a hero and you could write your check for the rest of your life. But it takes a lot of risk, and a lot of these people in this business don't want to do that. But I got to tell you, as an individual investor, there's great opportunity overseas. Can't throw darts. Need to be picking stocks and sectors that are good. But I got to tell you, folks, more and more in the McCall report in the months ahead, 2024, we're going to build that entire basket of international opportunities because I think they're there. They're not as exciting to a lot of people. They're not as sexy to sell. But I got to tell you, you cannot ignore it because I guarantee most of you, if I looked at your portfolios, are way overweight in U.S. equities right now, and you need to trim those a bit. So a couple other real quick ones. Outside the U.S., obviously, I think infrastructure, some of that money from the IRA, Inflation Reduction Act, is really going to start making its way through. And our infrastructure flat out stinks. So there's going to be a lot of great infrastructure plays. And copper, one other commodity, copper, I think is going to have its breakout in 2024. I think that's a place you want to be positioned. And I think China's economy starts coming back, not to where it was, but coming back a little bit more. It's going to push up copper prices. We need so much damn copper to keep up with renewable energy. It's mind-blowing. So it's a way, again, to position yourself to diversify outside your traditional assets. I think copper is a great way to go. But again, folks, we had basically a flat Q3 after one of the best starts to the year ever through the first 2 quarters, first 6 months. I think the fourth quarter is going to take off once again. The end of September is usually the worst 10 days of the year. Get that behind us. And I really think the Fed will be on pause, and that's going to just add a little bit of tailwind to us. And I think some of the small mid-cap names are going to lead a broad-based rally into 2024. So you want to be positioned in stocks, but make sure they're diversified, not all eggs in one basket. So enjoy the end of Q3. And of course, quarter 4, we're going to be here ready to go right into 2024 and beyond. Again, thanks for watching. Have a great rest of your week. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.